2002. A trillion-dollar machine is about to swallow the world economy, and it starts with 4 words on a billboard: own a home. Rewind to the beginning. The dot-com crash just gutted Wall Street. 9/11 just gutted the country. So the Federal Reserve does the only thing it knows how to do. It makes money nearly free. Interest rates crash to the floor. Borrowing $100,000 suddenly costs about as much as borrowing bus fare. And Americans do what Americans do when money's cheap. They go shopping. Except this time, the thing on sale is a house. Sir, your income doesn't quite qualify you for this mortgage. Not a problem. We have a solution for that. It's called the no income, no job, no asset loan. Bankers just called it the ninja loan for short. It was the finish line of the American dream, printed on a billboard on every highway in the country. Why rent when you can own? So the banks got creative. They invented an entire category of loan for people who, statistically, had no business getting one. They had a name for it too, subprime, which is banking speak for, we know you probably can't pay this back and we don't care. Should I really be borrowing this much? Don't worry about it. If you can't pay, we just take the house back and sell it for more. Housing only goes up. It always has. That one sentence, housing only goes up, was the whole foundation. Not a law of economics. A feeling. And an entire industry built a skyscraper on top of it. Loan officers stopped asking questions. Down payments became optional. Credit checks became a formality if they happened at all. If you had a pulse and a signature, you had a house. By 2005, buying a home wasn't about living in it anymore. It was about flipping it before the paint dried. I teach 3rd grade during the day. At night, I own 4 condos. I don't live in any of them. I don't plan to. I just plan to sell them. Home prices weren't reflecting how much houses were worth. They were reflecting how much people believed houses would be worth next year. That's not a market. That's a rumor with a mortgage attached. And underneath all of it, the loans were rotting, quietly. Nobody wanted to look too closely, because looking too closely was bad for business. So Wall Street did something clever and something catastrophic in the same move. They took thousands of these shaky loans, blended them together into one giant financial smoothie, and sold slices of it to investors as a safe, boring, reliable product. They had a name for it, the mortgage-backed security. Now, a smoothie is only as good as what you put in it. And what went into this one was, in large part, garbage. But garbage doesn't sell. So somebody needed to put a gold sticker on it. Enter the rating agencies, the referees whose entire job was to look at these bundles and tell investors how risky they actually were. And here's the part nobody put in the brochure. The agencies were being paid by the very banks whose products they were rating. Imagine hiring your own restaurant critic and only paying him if he gives you 5 stars. That's the system, AAA. Top marks. Safe as a savings account. It wasn't safe. Everyone at the top knew it wasn't safe. They rated it safe anyway. And Wall Street didn't stop there, because if you can repackage risk once, why not repackage it again? They took those same mortgage bundles, sliced them, recombined them into something even more tangled, and called it a collateralized debt obligation. Layers of debt, wrapped in layers of debt, each one a little further from the actual human beings who were supposed to be paying their mortgages every month. Almost nobody in the room understood what they were holding anymore. That was sort of the point. Almost nobody, except a handful of people who actually read the paperwork. Analysts, traders, a few stubborn skeptics who looked at the loans underneath all this and thought, this doesn't add up. So they went to the same banks selling this stuff and asked for something that didn't really exist yet, a way to bet that all of it would collapse. You want insurance against something that can never fail? Sure. We'll take your money every month. And if it never happens, well, free money for us. That insurance was called a credit default swap. And here's the strange part. You didn't need to own the thing you were insuring. It was like taking out a life insurance policy on a stranger's grandmother and quietly hoping for bad news. Banks were writing that insurance by the trillions, treating it like a fee they'd collect forever, because deep down, almost nobody at the top actually believed the bill would come due. It came due in 2007. It started small. A missed payment here, an empty house there, a foreclosure sign in a neighborhood that used to have a waiting list. Housing doesn't fall. That's not how this works. It fell anyway. And when it fell, it didn't just take down homeowners. It took down every bundle, every smoothie, every triple-A-rated tower built on top of those loans. Banks that thought they were holding safe assets looked down and realized they were holding radioactive debt with a gold sticker on it. We can't sell this. Nobody wants it. It's worthless. So what happens now? Now we find out who's been swimming without a swimsuit. September 2008. Lehman Brothers, a bank older than the telephone, collapses in a single weekend. No rescue. $600 billion gone in the time it takes to eat dinner. And the message landed everywhere at once. If a 158-year-old institution can vanish overnight, nothing is safe. Banks stopped lending to each other. Credit, the oil that keeps the entire economy's engine turning, simply stopped flowing. I run payroll on Friday. I need the loan by Thursday. There is no loan. There's no liquidity anywhere. Good luck. Multiply that phone call by a few 100,000 businesses, and you get the picture. Stores closing. Paychecks bouncing. Retirement accounts cut in half overnight for people who did everything right. By the end of that year, foreclosure notices were stacking up like junk mail. Unemployment offices had lines around the block. This wasn't a Wall Street problem wearing a suit anymore. It was a kitchen table problem in millions of homes all at once. And it didn't stay in one country. Iceland's banking system basically ceased to exist. Markets in Tokyo, London, and Sao Paulo all cratered within days of each other. The question stopped being who's next and became something much scarier. Is the whole thing broken? Which left Washington with a genuinely ugly choice. Let the banks fail and risk the entire global economy going down with them, or hand hundreds of billions of taxpayer dollars to the same institutions that had just detonated the bomb. I need $700 billion. For what exactly? To stop the bleeding. All of it now. They called it the Troubled Asset Relief Program. In plain terms, it was a taxpayer-funded airbag for the same banks that had been driving without a seatbelt. And it didn't stop at banks. An insurance giant that had bet trillions on this house of cards got a bailout of its own, and so did two of the country's biggest car makers. Meanwhile, the Federal Reserve was doing something almost as dramatic behind the scenes, cutting interest rates to nearly nothing, and then simply creating new money to buy up all the bad debt clogging the system. A financial fire hose pointed at a fire that was still spreading. And slowly, painfully, it worked. The banks stopped bleeding. The markets found a floor in early 2009 and started climbing back. But climbing back for who? Because while Wall Street was quietly returning to record bonuses within a couple of years, Main Street was left holding the wreckage. 8 million jobs gone. 4 million homes foreclosed. $19 trillion in household wealth erased. Families who had never missed a single payment in their lives were suddenly underwater on homes worth less than what they owed. They got a bailout. I got an eviction notice. That gap between who caused it and who paid for it didn't just create anger. It created a permanent crack in the public's trust. Nobody who built this went to prison. No handcuffs, no perp walk. Just quiet retirements and very large severance packages. By 2011, that anger had a name and an address, a park in Lower Manhattan, filled with tents and cardboard signs, one of which read, "We are the 99%. It wasn't really about one bailout anymore. It was about a system where the losses were shared by everyone, but the profits were shared by very, very few. The system survived. The trust didn't. And maybe that's the part worth remembering. Not the acronyms, not the swaps, not the bailouts. It's that the crisis didn't arrive wearing a warning label. It arrived looking like a good deal. A safe bet. A sure thing. That's usually how the next one looks too.